gold and silver prices, which are increasingly failing to reflect real physical demand, are beginning to lose credibility. And it's like COMEX and London are more about trading, whereas Asia is more about accumulation. And I think you can see that. Watch the flows of where everything is going. Don't look at the price. And Asia's just gobbling it all up. So we haven't seen the end of the gold and silver bull market, not even to begin with. And I think this time, if Michael Oliver is right, I think you'll see the public more involved. And I think that will make Steve St. Angelo's argument very correct on his interpretation of what happened last time.
Gold and silver are entering a phase where paper prices may no longer reflect real physical demand. The key issue is not just daily price movement, but where the metal is actually moving. Western markets like COMEX and London are still driven heavily by trading, leverage, and paper contracts, while Asia continues to focus on physical accumulation. Andy Schectman, a precious metals analyst and longtime market commentator, explains that this shift could become one of the biggest signals in the gold and silver bull market. He believes investors should focus on flows rather than just the spot price, because physical demand is quietly telling a different story. According to this view, the bull market in gold and silver is not over. In fact, it may still be in the early stages. If public participation increases and Asian demand continues to absorb supply, physical gold and silver could become far more important as trust in paper pricing continues to weaken. We're about to dive into highlights from Andy Schectman's interview. Before we begin, make sure to subscribe to the channel and enable notifications so you never miss our latest insights on gold, silver, the economy, and financial markets. Thank you, and enjoy the video.
One of the things, by the way, talking about the margin increases and the lack of open interest and all this stuff, the CME group just slashed both gold and silver margins. And so by a lot, by 9% in gold and 11% in silver. So they're trying to get the liquidity back into the market. And, you know, I guess I'll leave people with one thought. To me, what it really means by all of this is that the COMEX in London, their prices to me look more like local paper market prices, where Asian physical markets are bidding much higher. And you know, the crazy thing is with the war and the sell-off in metals in the West, rising bond yields put pressure on gold and silver, right? That's what we're supposed to be told for bonds that really no one across the globe wants. But in Asia, the interpretation is the exact opposite. And I believe it's the correct one. And that is that higher yields signal a falling dollar and a falling dollar purchasing power, making gold more attractive to begin with. So I don't know. I just think that the big money is telling you exactly where this is all going. And I think that the Western gold and silver prices, which are increasingly failing to reflect real physical demand, are beginning to lose credibility. And it's like COMEX and London are more about trading, whereas Asia is more about accumulation. And I think you can see that. Watch the flows of where everything is going. Don't look at the price. And Asia's just gobbling it all up. So we haven't seen the end of the gold and silver bull market, not even to begin with. And I think this time, if Michael Oliver is right, I think you'll see the public more involved. And I think that will make Steve St. Angelo's argument very correct on his interpretation of what happened last time. It would make it not as correct this time, because you're going to get a lot of buying, which will put much more, much less strain on the whole ecosystem, where if everyone has to put out cash while margin rates are rising, while the price keeps skyrocketing, while, you know, they have to rebalance ETFs, while they have to take huge allocations, well, that's the reason everything collapsed. But we'll see what happens this time. In any case, then again, in the legislation, it does say I can trade gold eagles with you or silver eagles with you if you'll accept it. I can't make you do it. And in theory, that's private. It's invisible. But in doing it the way that the states, I think, have it envisioned, is by doing it on a digital application based upon the money, your gold or silver held within a vault. Now, I haven't dug deep enough into seeing how they're going to fractionalize it, where if you have 500 gold eagles in a Florida depository or Texas depository, and you go buy a pack of chewing gum with your debit card attached to that account, how does it reconcile? That I don't know. I have to figure that out. But I guess what I'm trying to say is I don't think it's going to be very easy, short of an outright barter, for people to avoid tiptoeing back into that system. And I think this is something that is just the very beginning. I think it will get more and more so that way. Privacy and cash will become something that it was something that, kind of like your grandfather telling you a story. It will be an example of what was. Now, it's not going to happen all at once, but you can really feel it. And once the Genius Act is made official in January, they're finishing the final touches on the Clarity Act right now. As far as I'm concerned, precious metals will be one of the only ways to have any semblance of wealth and liquidity outside the system. But accessing that wealth in dollars, there's no way but to come back into the system. And even if the states are promoting it, you still have the federal capital gains tax to worry about. Now, if President Trump were to remove that, then you would have an argument that then, yes, metal would be an alternative to that. It would be. But until then, the feds still want their pound of flesh, and hopefully it goes away, kind of like Missouri, who just retroactively changed back to no sales tax on precious metals. They had no sales tax, Maryland, I'm sorry. Then they went to sales tax. One of the only states that went back to it. Now they just retroactively went back to no sales tax. Well, maybe you'll see the federal government realize that American gold and silver coins made by the U.S. Mint are legal tender. They're not currency as it is right now, but they're legal tender for all debts, public and private, issued by the U.S. Treasury Department. There's no reason they should be taxed. And if they got rid of that, then I would argue yes. I haven't heard it being brought into the metal space, but yeah, taxing of unrealized gains, especially in a world as fluid as ours, especially in a world where asset prices have been distorted to the upside to such a degree through suppression of interest rates, is beyond unethical. It is beyond unconstitutional. It's immoral. And, when you have a government that suppresses interest rates and floods the system with money to spike asset prices to make everyone give this illusion of prosperity, and now trying to fight that inflation they created, it's just a joke. And if they were to, if the market were to, that's why they can't lower rates, right? They can't. And if they do, they just make it worse. But if rates go higher on the 10-year Treasury, as it really appears it wants to, they want to, and we're seeing that across the globe with other G7 nations, then what really is fair value for asset prices? And to think of doing it to real estate is the height of idiocy. When think of all of your homes out there, everyone that you own, and think of what that house was worth during the pandemic at 3% mortgage. What's it worth at 7% now? What would it be worth at 10%? And so when you talk about valuations, we arbitrarily value things at this point in time in dollars in this interest rate environment. But what happens if the dollar begins to continually lose value? What happens if rates go much higher? What happens to the valuation? What's it really worth? And if by taxing unrealized gains in an inflated currency, by the time you have that, your currency is becoming worth less and less and less and less. And as rates go higher, your house is worth less and less and less and less, but you got taxed at the peak. Not cool. I don't know. I think that's horrible. I hope that doesn't happen with precious metals, but that would be emblematic of desperation and desperate governments, desperate municipalities doing desperate things. I haven't heard that, but let's hope it doesn't happen. It's about as bad as it would get.
The major warning is that Western gold and silver prices are beginning to lose credibility. When COMEX and London prices more closely resemble local paper market prices, while Asian physical markets continue to bid strongly, it suggests a deeper disconnect between financial pricing and real-world demand. Higher bond yields are usually described as negative for precious metals, but this analysis argues the opposite. Rising yields may actually signal a weaker dollar and declining purchasing power, making gold and silver more attractive as stores of value. The CME's cutting of margins on gold and silver may also signal an effort to restore liquidity to the market. But the bigger story remains physical demand, falling confidence in paper assets, and the growing role of precious metals outside the traditional financial system. Let's get back to the interview.
Steve St. Angelo wrote a report. You were kind enough to send it to me. I've been a fan of Steve's work for a long time. He's a smart guy. I agree with what he said. His take on what happened with the market was accurate. But I think when he takes it and moves it forward, he's kind of missing one very important point. What he spoke of was the environment we saw, where you had rising margin rates, you had a massively escalating price, and you had what I would argue is more selling on the retail side than buying on the way up. Then there was a lot of buying, but more selling. You had a whole bunch of people that since 2020 and even before had been holding gold and silver, were bummed out with the counterintuitive way that it worked, the price action, the volatility. Even though it kept moving higher, I think they were holding it largely for reasons that I wouldn't tell people to hold metal. They were holding it to become wealthy, not because it is wealth. And I would argue those people are gone. They have let go. They're not coming back. A lot of those people. And they walked with profits. As it went up above $100, we saw tremendous selling. Now, that selling came into an environment of massively higher margin costs of 300%, and the rebalancing of the ETFs the first 2 weeks of the year, plus the first couple of weeks of the year, the big primary distributors have to take allocations for the new product from the mints. They're obliged to. So you have massive selling, raising margins, rebalancing of ETFs. Those two things alone are guaranteed to crush the price, plus demands by the mints, if you are a primary distributor, take their 2026 allocations. Couldn't have happened at a worse time. So he was saying that the bids were horrible because what was happening was that the cost of maintaining the inventory ran head first into rising costs, into rebalancing of the over-levered ETFs that guaranteed a cascading of selling to rebalance, to put those prospectuses in line, coupled with you have to take millions and millions and millions of dollars worth of new stuff, and everyone's selling. There was less buying than selling. So let's reflip the switch. I mean, he didn't talk about what it was like a few years back during the pandemic when there was far more buying than producing. And what happened to the premiums? They went parabolic, including the bid premiums. We were paying $9, $10, $11, $12, $13 over spot for Silver Eagles, $9 over spot for junk silver, $200 over $1,000 gold spot, or $2,000 gold spot, nearly $1,800 for Gold Eagles. So I think he was accurate in his depiction of what we saw at the beginning of the year. But I think in this environment, the weak hands have been washed out. The open interest on COMEX, same thing, has been washed out. Lowest level in 30 plus years in terms of who wants to play in that sandbox. So the weak hands are gone. And so now the strong hands hold the middle, where a price move, I think you'd see the price continue to go higher and you wouldn't see this cascade of selling. And when you get the public jumping in, if just a small fraction of the public jumps in this next time, as I anticipate at one point they will, then you can turn that thesis upside down. Because what you had was the big dealers and companies like mine constantly pouring out money to buy product from the public, to buy product, the new stuff from the mints, to a 300% margin increase, to the guarantee of prices collapsing because of the ETFs rebalancing, creating, along with the margin increases, margin call after margin call after margin call. The costs were extraordinary. That was a one-sided argument. What happens if the script gets flipped and the public starts buying and there's more buying than there is selling because the selling's been exhausted? So I don't look at that as being something we will see again. I don't. I mean, I hope not anyway. I guess it is possible, but I do think that largely the people that wanted to sell sold. And that would have been at over $5,000 an ounce gold and over $100 an ounce silver. And they did. I don't think you'll see that this time, as it will be more about rushing to get what they can in an environment where 10 stocks have held up the entire market for months upon months, in a market where the Dow Jones relationship to the S&P 500 is at its lowest level in the history of the two markets. What that means is the Dow Jones are the legacy stocks, the big old, the the Johnson and Johnson, the stocks of the economy, right? The big ones. And they're at their lowest level related to the S&P, which is all about financialization and digitization and AI, not the productivity of the United States. And you look at the S&P 500 and you see 7 to 10 stocks holding it up, 490 falling. You're seeing a period of time where you have all-time highs in the S&P, followed by, look at most of the stocks on the S&P, they're hitting all-time lows. So this isn't a situation where everything is all messed up in many ways, and including that last environment where the public sold, the big money bought, and the CME group raised margins at the very worst time, knowing that the ETFs would be rebalanced, knowing that the primary distributors at the same time would be required to take new allocations. I mean, if this was the worst time for that stuff to happen, and it created an environment that Steve St. Angelo articulated well. But I think it ignores the public's involvement in the next move. And if the public jumps in, then that environment becomes as fluid and the market becomes fluid and liquid as ever. It's just, it can't be one-sided, or that creates a lot of problems.
Andy Schectman's message is clear. Gold and silver are no longer just inflation hedges. They are becoming a reflection of trust, liquidity, and control inside the global financial system. As digital money, stablecoin legislation, and financial surveillance expand, physical precious metals may become one of the few ways to hold wealth outside the system. The prediction here is not based on a random price target, but on a structural shift. If Asia continues to accumulate, if Western paper prices keep failing to reflect physical demand, and if the public enters the market more aggressively, gold and silver could enter a much stronger phase of the bull market. This is why investors are watching COMEX, London, Asian demand, the US dollar, gold margins, silver liquidity, and physical metal flows so closely. The market may be telling us that the next major move in precious metals will be driven by real ownership, not paper speculation. We'd love to hear your perspective on the ideas shared in this interview. Leave a comment below and join the conversation. If you enjoyed this video and found value in the analysis, please like, subscribe, and click the notification bell to stay updated with future content. Thank you for watching, and we'll see you in the next video.